Magnus best test here. So what is a stochastic oscillator? Basically, it's a percentage difference between the highest high and lowest low during some period of time. In this case, we have default values here, 14 candles. This is the fast line, the percentage K. The percentage D is the 3-day or 3-candle moving average of the fast line. So in this case, the percentage K. And we have a smoothing period here, 3, and it's all moving average is a simple moving average. So let's go. Here we have the fast line, the percentage K. It's blue, and the orange one is the percentage D, and is the 3-day moving average of the blue line. Very simple. The difference between stochastics and RSI is, so RSI is also a momentum indicator as stochastics, but RSI takes into account, it's calculated based on the changes, percentage changes of price movements, whereas stochastics takes into consideration the current closing price and in relation with the highest and lowest prices. So stochastics works better in a ranging environment. So you need to be really careful to be either in a range, and even better, when you take a trade, it needs to be in the trend. So for example, you would wait here, it goes up, you would wait for a bottom and up signal. So basically the blue line crossing the orange line and take the signal here. You would not be taking the sell signals here because we are in a uptrend, also measured by this moving average red line. Here we have the formula equation for stochastics. So this is the percentage K, the blue line. C is a closing line minus the low of the last 14 candles, and then divided by the highest 14 candles point minus the lowest 14 candles point, and then everything nicely times 100. We have a nice percentage. So pretty simple. The history, like, it was invented in 50s by George Lane. Default is 14 period, 14 bars period. Okay, doesn't need to be days. And basically the general theory serving as the foundation for this indicator is that in a market trending upward, the prices will close near the high, and in a market trending downward, prices close near the low. And one fact that is also interesting, that George Lane, the inventor, thought about this indicator, that the most important thing is to take into consideration the divergences with the price. He thinks this is the best value out of his indicator, checking the divergences. So I'll just do a trend line. We have one over here, so basically something like this, where here we can see the price made a lower low, but the oscillator, the stochastic oscillator, made a higher low, and truly we are going upward. I already know I don't like indicators, and basically I'm debunking one by one those MACD, Bollinger Bands, Donchian channel, all those different indicators. Basically they are like half truths, can be very confusing, and mostly they make you a worse trader. And the moment you become a better trader is when you make things simpler and go away from those indicators. Basically just follow the price, read the price more, only read the candles, the speed, how they develop, the different details about every candle in relation to the previous ranges and so on. This is the secret of trading. So here debunking the stochastics indicator. Of course we have false signals. Sometimes it works, sometimes it doesn't, and this is the problem. As with most indicators, even if you combine them, still you just cannot have a good strategy. And of course I never say never, but mostly it's in the end it will get to you, and you will have much more problems to become profitable than if you just start to focus on the most important thing, which is the price. So here, for example, even we are taking into account the trend, so we are going down. This is a good signal. Let's say that you would enter over here and you would have some profit. But what would happen if you enter here? You would get into a loss. So your stop loss would be somewhere around here. That's a loss. Over here, depends on you, on your risk management. But here, so maybe profit or break even. Here you would end up in wait. let's say you take it over here, this will be profitable. So let's say we already follow the trend, which we think also the problem with trend, you never know when it ends. So this is the problem. But let's say we just want to go down, so we don't trade this, and we wait when it crosses, when the blue line crosses the orange line. Here we take a trade and it's a loss. So this was a false signal. So now basically we are break even or even losing, because we need to take into account the fees, the trading fees on the broker. Let's say, and here it can be even confusing. You don't know like which one you take it here, but it's like consolidating. Let's say we take this downwards, and this is a profit. Okay. Here, let's say we see the trend is already maybe about to reverse. We take it. This is a profit. Here we cross the line, the orange line, so take a sell, and it's a loss because it continues up. So let's say here we are down, oversold, crossed the line, so let's go up. And this is basic. So depending on your stop loss would be somewhere here. This may be 1-to-1 win. Okay. And here crosses down. This is a win as well. Let's say, what can we do here? This is what I'm talking about being confusing. Here, some people could take a trade because it more or less crossed, but that would be a loss because it went down. Here, there's no trade near the extremes. So let's say you take a sell here. That would be a win. Let's say we take a, so this is consolidation. You would take a buy here because it crossed, and it's a loss because we would be crossing up and it goes down. Here also we are crossing up, but it goes down, so another loss. Take into account that when it crosses, this is the candle where you would be entering. So in this case, your stop loss here maybe 1-to-1, but basically it's a loss because it turned up. Even though you might think that you have seen some good signals here, the problem is that you don't see the future. You see just something like this, and you think it crosses. Sometimes it just crosses, or then it doesn't, or then it even changes the crossed, but then it turned back and it was not crossed, and it continues down. So in a real life situation, it's not that clear. Even those trades that were here winning trades. So in a real life scenario, this strategy is a losing strategy, and you would find out very quickly once you trade on the real market and not backtesting. You should be focusing on the price, on what's currently happening on the market. You should follow the volatility, the speed of those candles, the patterns that are on the chart, how the chart looks, and you should try to check the situation in this way. So thanks for watching, guys. Hopefully you now understand a little bit better how stochastics work. Hopefully now you understand why I don't use indicators, why I focus only on the chart, only on the price action, and why I am so good at it. Indicators, they are delaying your progress. Let me know in the comments what you think about it, which indicator you would like to have debunked in my next videos. And thanks for watching. Have a nice day.